Hey guys, Bob Hertzog, your real estate dad. Hey, I've got a great episode today. I brought Lizy in to talk about two things. Number one, the conforming loan limits that were just raised to 832,750, I believe it is. That's big news for mortgage rates. And then we started talking about, or we got into the 5-1 arm, 7-1 arm, 10-1 arm. We're starting to hear more about adjustable rate mortgages. So I wanted Lizy to kind of explain what those mean and what she's seeing out there, who they might be good for, who they might not be good for. So I hope you enjoy this one, and we'll talk soon. Hey guys, Bob Hertzog, your real estate dad, here with my favorite lender in the world, Lizy Hoeffer, to talk about a couple of topics that we haven't heard about in a while. Number one, we're going to talk about the conforming limits changing recently to $832,750. That's what kind of the cutoff line that puts you into a jumbo versus a conforming loan, and Lizy will go over that real quick and what that means. And then we're going to jump into something we're starting to hear about more and more that we haven't heard about in years, and that's people are starting to talk about adjustable rate mortgages, ARMs, 5-1 ARMs, 7-1 ARMs, 10-1 ARMs, 6-2 ARMs. I mean, there's all these different kind of ARMs out there. Lizy's going to kind of fill us in on what the reason is, why we're hearing about those more, and what kind of a reduction you can expect when you go with that kind of a product, an ARM versus a standard mortgage, and who those might be useful for. So thanks, Lizy, for coming in today. Let's talk about the new conforming limit that just came out last week.
Yeah, it's really exciting, especially in Phoenix, and Maricopa County, where home values have really increased. It's really for a lot of people, I mean, jumbo financing is more difficult to qualify for just for the sheer nature of the size of the loan. And so, with a jumbo loan, you have to have a much larger down payment. You have to go through more strenuous guidelines. You have to have more reserves. You have to have a lower debt to income ratio. And so it just limited people's ability to purchase. So having a loan amount where as a first time home buyer with 3% down, you can buy a property that's like $858,000
Mm-hmm.
is gonna make a huge difference, especially as home values have risen so much.
Right.
So I'm pretty excited. It also means that FHA loan limits are gonna increase. You know,
Mm-hmm.
Typically the FHA is about 65% of, where the conforming limit lies. I mean, our FHA loan limit in Maricopa County is already over that,
Okay.
but they're expecting the FHA is gonna be somewhere around like 465,
Wow.
or excuse me, 565. Which is
Oh,
really huge.
that's
Right now, I'm
what
about 546, 250. So 565 for an FHA loan would be huge. Now that information comes out later, so I'm sure you're gonna let everyone know, but, it's pretty exciting stuff.
I didn't even know that they were up that high at even the 540 range.
Mhm. I mean, and FHA financing is, a majority of first-time homebuyers use that product because it has more flexibility for FICO scores and
Right.
credit guidelines. One other positive thing about the conforming loan limit is that VA tends to follow that,
Right.
right? So, if you have a VA loan, you can get all the way up to, 832,750. I mean, it's pretty huge.
And put nothing down, basically. I mean,
I mean, it's nothing down. I mean, it's just it's really nice to see.
yeah, yeah. Okay, let's talk about ARMs for a second.
Yeah.
All of a sudden, we're starting to hear about adjustable rate mortgages. So tell us, I think most people watching this are going to know what that means, but well, let's just say when you hear 5-1 ARM, what does that mean?
It means that the rate is fixed for 5 years and then will adjust every year after that.
Right, but you can refinance at any point during that 5 years,
You
correct?
can.
Yeah.
Yeah. I mean, some banks have prepayment penalties. It's very rare to see it.
Okay.
A lot of ARMs, they just haven't been super competitive products in the past couple of years. It's typically because the 30-year was so low that why do that?
Right.
And then, then we had this crazy inverted yield curve where everyone was like,
Yeah.
you know,
Do you think they're gonna the 5, 7, 10-year, or 10-1 ARMs are gonna start coming down more than where they are now, right?
Yeah, I mean, We've already seen a pretty significant improvement in pricing as the market is normalized. As it becomes a more normal, interest rate market. I mean, this 7 to 8% was just not normal. It was such a rapid increase from like 2.5, 3.5% mortgages, so such a big swing. I definitely think ARM pricing will become a lot more attractive. Typically, ARM rates are about a 0.5% lower than a 30-year fixed rate. And you can already get that now. Now, the difference is that it does cost you, so there isn't a par rate really that's like if I was comparing par rates, I might go with a 30-year fixed mortgage because I don't think the difference is
Mm.
that significant. But if you're willing to pay points, and in this market, the sellers are paying closing costs,
Yeah.
you can get a conventional loan in the
Mhm.
fives right now.
Yeah. And what about refinance? Because here's where I'm hearing it. I'm hearing it from people that, my clientele, a lot of them have been in their homes for 5, 7, 10 plus years, and they might be sitting there with a 3.5% mortgage, 4% mortgage. So they're not real excited about going out and buying another home right now and taking on a higher mortgage rate. And they're saying, hey, I think I just want to do some remodeling and stay here, for at least the next 5, 7 years. That's a pretty good opportunity for them, possibly, if they want to put $100,000 into their house, into a remodel, and do like a 5 or 7 year or 7/1 arm, and refinance it into that. What are your
So
thoughts?
I'm not it really depends on the scenario, okay? And so this is like why it pays to talk to somebody who's actually good at loans
Yeah,
and isn't just somebody who can do your loan,
right.
right? There's a big difference. If somebody had a 3.5% interest rate and they were only going to do $100,000, that might be better suited for a line of credit,
And a HELOC.
a HELOC. And the reason I'm saying that is because their larger principal is going to be at a much lower interest.
Yeah,
And
that
this
makes sense.
100,000, while it might be, depending on what you find, because it's typically prime plus, and the plus depends on the loan to value and your credit score. But assuming it's like 7.5%, okay? Like no one wants to pay 7.5% on 100,000, but your blended rate is still going to be less than what's available ARM and you're not paying the fees to refinance. So I would definitely look into that. The other thing that I would also look into, because there are a lot of people that are very married to that 3% rate
Yeah.
and they are forgetting about the tax implications of the big, beautiful bill because there were a lot of changes to that actually made buying an upgraded property more attractive.
Okay.
And I do think interest rates are coming down. I do think that's where we're headed. And so if you look at, the fact that you can get full interest deduction permanently on 750,000, plus you can write off all of your state and local income taxes in addition to all the property taxes and your mortgage insurance, I mean, you get a pretty substantial tax deduction. Like, I think when I was doing the math on it, like, people were saving $600 to $1,200 a month if you, like, took what they would be paying less in taxes and divided over 12 months. So, I mean, that's in and of itself maybe a reason for you to upgrade.
Yeah.
Now, I'm not saying you're gonna pay a much lesser mortgage payment, but, I mean, I don't know, you have lived in construction.
Right.
I mean,
Oh, yeah.
it's awful.
It's the worst.
Mhm. And so it is just something to think about. I mean, I think people here's what I normally see because I do a lot of refinances. People will take out the money to do renovations, and then they'll do something else with the money.
Yeah. Yeah.
And they always end up selling anyway and just getting into more debt.
It might be a good option if someone's got a HELOC that's sitting there with a high percentage rate, and maybe they've got a lower percentage rate on their main loan, and they know they're not gonna be in that house for another 7 years, to do a 5 or 7/1 arm.
It really depends on the amount of the HELOC. See, this is, like,
Yeah.
where everything comes and also, like, for people just doing debt consolidation, you really just have to look at your blended rate.
Yep.
I've seen a lot of people with a $300,000 mortgage that's, like, close to 4%, and then they have a $200,000 line of credit
Yeah.
at 8 or 9%, okay? That's a very different scenario.
Right.
And then I've also seen people with a 3% first mortgage, and they've got 22% on their credit card, and they've got
Oh my
10% on their auto loan, and they're paying God knows what for student loans, and the thing is, it's like, that scenario is terrible.
yeah.
That scenario, you're absolutely paying higher than 3.5%, and again, if you don't understand blended rate, you can't make a good decision about your mortgage.
So the bottom line is they need to call you.
But an ARM might be a solution for
Yeah,
you. Yes.
but that's what I'm saying is you have access to all those. I mean,
We do. We have a lot of access to them. You just really have to like, most people are living in their homes 13 years. Like, that seems to be the longest time that people will live in their homes, and so if you know that you are already kinda creeping up in years
yeah,
and, like, your chances are you're just not gonna live in this house much longer, in my personal financial opinion, it probably makes sense just to sell and move.
yeah.
I mean, and you've seen that too. Like, you've made that move when you're
Oh,
like,
yeah.
"Well, I don't know. I think I'm gonna like, what happened?
Yeah,
You remodeled your kitchen and then you decided to sell."
yeah, yeah. Went through all that pain for nothing. God.
But you remember you're like, "No, we're just gonna stick it out. We're just gonna do this. We're gonna live here we're gonna try to do it
Yeah,
another
and of
5, 10
course, Gary
years."
told me, "You are not gonna like living in this neighborhood, in this house," and I told yeah, I just never mind, that's we won't go down that rabbit hole. She was right again. So these tax break the beautiful bill tax breaks that you're talking about that are coming for homeowners, is that retroactive to the 1st of 2025, or is that for 2026 tax year?
I think it's available now. I'm not an accountant,
Yeah.
so that's something you'll have to check, but all of those changes, I think, went into effect when the One Big Beautiful Bill passed.
Yeah, I know there were some huge, huge tax advantages that were in there for homeowners, so cool. Well, thank you for coming in and explaining that, especially the whole thing about arms, because like I said, we're seeing it more. People are starting to ask me about it. I'm starting to see it more online. So I thought anytime I hear about something floating around in the media, I bring you in and get everyone straightened out. So thank you for taking the time.
Yeah.
All right.